Almost all traders fail because of one huge mistake. How many times have you placed a trade? Everything looks perfect. Looks like a great setup, only to watch price fly straight through your stop loss in the opposite direction, only to leave you feeling lost, confused, and wondering how that even happened. 90% of the time, this happens because you're on the wrong side of the market. You're expecting that price will trade higher, but actually, the truth that it was going to trade lower was staring at you straight in your face, but you just couldn't see it. What you need is a framework, a proven step-by-step process that can tell you exactly what direction the market is most likely to trade in. And in this video, that is exactly what I'll be sharing with you. I'll share the most important things that you need to know to make sure that you're on the right side of the market more often than not. At the end of this video, I'm actually going to be breaking down this step-by-step trade breakdown of the trade that I took a couple of days ago now that netted me just under $6,000. And most importantly, why what I'm going to be sharing with you today is actually the main reason that I was able to take this trade. So let's go and get into how to understand directional bias. Let me ask you a question. If this is the chart that you were looking at, would you be interested in buying, so going long and expecting price to trade higher, or would you be looking at selling, expecting price to go lower? Or how about now? If this was your chart, would you be looking to buy and go long, or would you be looking to sell and go short? Or maybe how about now? Would you be looking to go long, or would you be looking to go short? If you answered anything other than I don't know because I need more understanding of what's really going on, then I can almost guarantee that you aren't a consistently profitable trader. Because the truth is, you can know all the concepts in the world. You can know about order blocks and fair value gaps or indicators, chart patterns, whatever it may be. You can know it all. But if you don't have a repeatable, systematic, rule-based plan on exactly how you define whether you should be trading higher or whether you should be trading lower, the reality is everything else is useless. At that point, you're just gambling, because every day that you come into the market, the first question that you have to understand is, should I be looking at higher prices or should I be looking at lower prices? And the only way to get that clearly is market structure. And what most people do is they gamble and they guess. One day they can look at something and they'll think that price will go lower. A week later, they could see that same or similar chart with everything how it was before, and maybe they think that it's going to go higher. And this randomness causes inconsistency in your results. So you can know all the fancy gimmicks, but the most valuable and most important piece of anything is your market structure. And more importantly, a proven, systematic, and repeatable system that enables you to know whether you should be long or whether you should be short, and not coming here and trying to guess whether it's bullish or whether it's bearish, which is what 90% of people do, whether they know it or not. I'm telling you, this is something that I struggled with immensely when I started trading. I mean, I've been trading for over 5 years now, and I really became consistently profitable when I built a rule-based process for how I read market structure. I tested thousands and thousands of trades, so many different ideas, and that's what it actually requires to get a statistical edge over understanding when we go higher or when we go lower. So the truth is, if you don't have that, and if every day you get to the market and you have to guess whether we're going higher because your rules don't tell you so, or you have some rules but they're not really consistent, they're not objective, then the reality is that your results will be incredibly inconsistent. When I get to the markets in the morning, the first question I ask is, are we bullish or bearish? Am I looking for longs or shorts? And I don't answer that question. My rules answer that question for me. And that is why I'm able to achieve the consistency of success. This is also exactly what I share to my clients inside of Prosperity School. I share this step-by-step frameworks, plans, proven systems that enable them to remove the guesswork from their trading, remove the randomness, remove the inconsistency, and let their rules and objectivity, and most importantly, proven data, handle their decision-making for them. Because the truth is, as humans, we aren't great traders, but we are able to build systems, and our systems, if they've been built properly with data, they'll be able to do the work for us. And then our job is just to follow the rules. So if you're coming to the market every single day and you're guessing and hoping and wishing and praying on market direction and entries and exits and all of these things, you've got it all wrong. And you're watching YouTube videos consistently hoping that you'll find the magic system or the magic edge, when in reality is you've got your entire framework of thinking wrong. So let's walk through this trade that I took, which is right in here, this long position that netted me just under $6,000 in a couple of hours, and give you the framework as to how I knew with a probable edge that the market would do this. If you look at the market and you zoom out, we're on the 50-minute time frame here on euro dollar. Now, if we go to the 4-hour time frame, which again is important, you need to have multiple time frame analysis. To be able to understand what's going on one time frame, you need to understand how it relates to another. So we're here now on the 4-hour time frame. Many people see this, right? And they see that price is bullish. Now, I also see that price is bullish, but here's where it gets interesting. If this was to happen, right? If we was to break this low down here, for me, we turn bearish, because that's what my rules say. There is a specific framework that occurs inside of this pullback that tells me that this is now the new swing structure. So whilst most people look at this and this is their low and this is their high, for me, no. The low is here and the high is here. And actually this high and this low don't count. So this isn't a pullback, this isn't a high, and yet this is a high and this is a low and this is a high, because my rules tell me so. Because this is the exact system that I've developed over the past 5 years with thousands of trades testing multiple hypotheses. This is what has worked for me. 4 hours bullish. We're inside of the discount. Now, what is premium and discount? Very simply put, market structure moves like this. At all times, you have a premium and a discount. So you can take the fib. If you're bullish, you can map it out from the low to the high. And anything that is below 50%, so in here, that is discount. Anything that is above 50% is a premium. It's a very simple concept. Imagine, for example, you wanted to buy something. Would you rather buy something at a premium, meaning more expensive, or would you rather buy something at a discount, meaning less expensive? The likelihood is you would rather get a discount. And really, that's how the entire market looks at price. So buyers want to be buying at a discount, and sellers want to be selling in a premium. So when price reaches past old highs and continue trading higher, now we're in premium pricing territory. This is where sellers are most likely to step in the market, because they know that they are selling price at a premium. Price hasn't even come to this level in a very long time. So we know that we're at a premium. So at this point, we know that there are likely to be more sellers than there are buyers. Now, the moment that we get into this 50%, right, below the 50%, which if we take that and have a look at our charts from this low to this high, the moment that we get below this 50%, we are essentially good. This is the area that you ideally most of the time want to be longing. So we are inside of a bullish 4-hour time frame. And the 15-minute time frame, this is how price looks. You can see here the price was bullish. So we essentially put in these legs, we had a range bound price delivery, we had a new high, a pullback, and then a new high. Again, my edge tells me this here isn't a high. It doesn't meet my criteria for a pullback. I need to see multiple candles inside of my pullback. So this is my swing high, this is my swing low, and this is my swing high for the 50-minute time frame. So we come back just before we were looking at taking this trade at London Session Open, 2 a.m. EST. This is how the market looked. We are bullish on the 50-minute time frame. So my job when I'm coming into the markets in the morning is to understand what is the objective of the day. And most of the time, the objective of the day is primarily based off of structure, with a couple of little pieces inside of that. So what I want to identify is my structural leg. Well, I've already done that. I have my swing low down here and I have my swing high up here. As an intraday trader, meaning I'm primarily focused on 1 to 2 sessions per day, given 3 hours in each session. Those are my windows of opportunity. So what I need to do is I need to identify what is the likely move of that session. So when I'm coming into the markets, I have a low down here, I have a high up here. I'm coming into the market in the morning already biased to go long. We have our swing low, we have our swing high, and where are we? If we take our low down here, we take our high up here, we're already below the 50%. So anything below here is inside of the discount. This to me is liquidity. So we have equal lows, right? Liquidity is also a very important thing, less important than market structure. But once you have market structure, it becomes extremely important. Liquidity alone without the understanding of true market structure is useless. But we have liquidity here. So I know that I shouldn't be buying before we've taken out this liquidity. So I know I need to buy underneath this liquidity. Well, now I need to identify an area of interest. So we have a very clean order block in here, right? An area of demand. Why is this an area of demand? Well, what you want to look for when identifying supply and demand is when price goes bullish like this, you have aggressive bullish move to the upside. What you will usually see before we get that is this here, which is a sell. So sometimes it looks like this, where you have a push up, a push down past an old low, and then aggressive run up, giving you a break of structure. Well, if you look at price here, you'll see that price was come down, we pushed up, we come down, we pushed up, we come down, and then we go up aggressively, especially in small trading ranges, is you want to be looking for the sell to buy, the order block here. This takes the liquidity of the old low. So we have a really nice liquidation of price in here, and it gives us a break of structure. This is the area I'm interested in. Most people are looking at this area, and this is where they go wrong. Most people look and they think that, no, this is the high, this is the low, and this is the high. And therefore, we're bullish from here, and therefore I expect price to go long from here. And they see a beautiful order block in here, right? The sell before the momentum. And this is the area that they want to use. And then London session opens. And now look how London session's opening. London session is opening with bullish price movement. So what do you think everybody who looks at the market as it's bullish from here and we're bullish from here is looking at in this moment? Even a lot of smart money traders. We've had a nice manipulation of Asia session low. We've had a nice internal market structure shift. So many traders are looking at this as a buying opportunity. But my market structure rules tell me that this isn't a pullback, right? It's rule-based. It's not subjective. It's not random. It's following specific set of guidelines that tell me that we're bullish from here, not from here. So as London session opens, I'm looking for a manipulation of these lows into this area of price. Manipulation into here, lower time frame shift, and then trade longer. That is my game plan. That is exactly what I was looking for. In fact, I'll even just play a short clip of me live forecasting this exact piece of price to my members just before it happened. If we could take the sell side first into here and we have the buy side still to take, it increases the likelihood in my eyes that we end up targeting that area. And so for me, that's kind of what I want to be getting involved in. And that is ultimately what I do share to my clients inside of Prosperity School. I give them the rules, the frameworks, the systems, step-by-step processes on exactly what to do and how to do it. And then daily, I give these outlooks because I walk my talk. I give the outlooks on exactly what I'm looking at today in price according to my rules. I see so many traders that struggle to achieve consistency and even profitability in general because they don't trade rule-based. They trade random, they're guessing, they're emotional, and most of the emotions come because you don't have certainty, you don't have confidence, you don't have clarity, you don't know what to expect. And so that is ultimately what I help my clients inside of Prosperity School overcome. It's the lack of clarity. So by giving them a framework, giving them a step-by-step process, a blueprint on exactly how to read the market to have an edge that leads to consistent profitability. And ultimately, when you have that, then trading becomes a lot easier. No longer do you have so much emotion because now you're trading through clarity. You know what you're looking at. You know why you're looking at it. You have the data to tell you that it works. So you don't need to guess and worry and take random action when you're inside of a trade because you have the information. You know the likelihood of this playing out. And so that allows you to be less emotional, less guessing, and most importantly, that is consistency. Now, if you would like to work with myself and closely with my team so that we can give you our step-by-step processes and systems and rules, you can book a call with one of our team members to see whether or not we could possibly help you in your current situation by giving you the frameworks, the tools, the systems, the processes, and the rules to enable you to trade consistently. So if that sounds like something you're interested in, you can go ahead and book that call down below. After I give this to the Prosperity School clients, once price lands inside of this level, my job now is precision. The reason that I don't just long from this specific area in here, for one reason, sometimes it can give you lower risk to rewards. So I ended up taking a decent amount of my position off at around this level and some of the position off at around this level. Now, sometimes it can give you a higher risk to reward to do what I'm about to show you, but the most important part is the confirmation. Think about it. If you needed to make a decision and you have two choices, you have option A and you have option B. Now with option A, they tell you that this could work. And option B tells you that this not only could work, but it's very likely that it will work. What option would you choose? You would likely go with option B because there's more certainty behind it. Well, that's exactly why I use lower time frame confirmations. So when we get into this area that I think will hold price, there's a good chance that it will. But when we get in there to confirm it, to get more clarity, I can go to a 1 minute time frame. And then when we're in the 1 minute time frame inside of here, right, we take it just a little bit back before we get into this level. You'll see that as price is coming down, the 1 minute time frame looks extremely, extremely bearish. And so it looks like I'm buying a falling knife. Now, instead of just buying on here and hoping that this price holds, I can wait for the confirmation that this price is likely to hold. And the way that I can do that is when we get into here, we drop down to our 1 minute time frame, and then we see how price reacts. So we want to see basically a slowdown of volume. So what you can see is that price is aggressively coming into this area. What I want to see is I want to see a little bit of a stagnation. This shows me absorption. This shows me that people that are coming into the market in London Open, there's a lot of aggressive selling momentum. The people that are supposed to be controlling price from here, right? Smart money, large money, big money, that are supposed to be protecting this area of price. I want to see them step back into the market and regain control. What they'll have to do to do that is defend it. So when price comes into here and the sellers are trying to push price lower, what buyers have to do is they have to absorb those orders. And so for every time that a seller tries to sell $100 million worth of euro-dollar, the buy side of the market has to buy those $100 million worth of orders so that price starts moving sideways. And this is kind of what we perceive to be fair value. So I want to see price start accepting this area. And then when it accepts this area, I want to see sellers stop trying to attack this price and then allow buyers to take price back up in the direction. And so what that looks like objectively is that we'll start ranging and then we will advance out. And then I want to see confirmation. Usually I'll use my specific method on how I get in with a certain criteria on what is deemed a high and a low. But I also have a rule that if that is not available close to my entry, then I can do X. Again, everything is rule-based. It's objective. It's systematic. My usual rules, I would have to see this high get broken for it to be a confirmation. But I have the rule that if it doesn't make logical sense to have to wait that long, then go for an alternative. And the alternative is always a market structure shift. So a market structure shift would be when price comes down and puts this low and then has a bullish reaction and then puts in a new low, or that right there would be my fractal, right? That would be my market structure shift. If we break this high, I would get a bullish market structure shift. And if we break this high, I would get an official change of character. They are two different things defined by two different rules. So if I get the break of this high, then I can enter. And so that's what I'm doing. And you can see that price slowly stagnates. We have, sellers try to push price off, buyers step back in, sellers try to push price back down, buyers are absorbing it. So this right here is called acceptance. So when we see this absorption, eventually what will happen is as price stagnates going sideways like this, sellers will realize that they aren't having the effect that they want to have, and so they will stop selling at this price point. They will know inside of the order book that there are buyers willing to protect this price. And so it no longer makes sense for them to fight this war. And so they're happy to step out, close their positions as soon as possible, and wait for a different opportunity. At that point, when those sellers step out, it requires less buying activity to push price higher. And so then I want to see the overpower. I want to see buyers overpower sellers. And that right there is exactly that. So when price comes into my area, I see stagnation, and then I see confirmation of a reversal. What that does for me is that confirms that this is the area that I want to work with. If I go back to the 15-minute time frame and I look at it now, it's still the same thing, low to high, but now we've confirmed that this area right here is the area that I want to be working with. And so now I have a higher chance of this trade playing out in my favor as opposed to just trying to buy here and put my stop loss here. Because sometimes price likes to change character. It happens. That is why rules and systems are so important to make your decisions for you. So now I have my confirmation. We're bullish. That's my bias. That's what tells me what I should do today. Then I have my liquidity, which tells me where I should avoid getting in. I have my order block, which tells me where I should get in. So now I have a full picture. I know that I should long. Okay, now I know I should long. The next obvious question is, where do I long from? Well, to find out where I should long from, I should first figure out where I shouldn't long from, right? Charlie Munger inverted thinking. So then I ask myself, well, where wouldn't I long from? Well, I wouldn't long above this low because of this liquidity. Great. Therefore, I would long below it. Okay, what else? Well, I would like to see an order block. Okay, order block, great. What else? Well, that's everything. So now I should long and I should long from here. This is the sequence of thinking. It's all obvious logic flows. I should long from here. Then what? When should I long? That's my confirmation. Well, we've just seen that in the lower time frame. So now I should long. Okay, I should long. I know where I should long from. Now's the time to long. Where do I long to? When do I get out of this trade? Do I get out here, 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 here? Right? Where do I get out of this position? Well, for me, on this specific day, you can see it's Wednesday, 12th of March. Later in New York session, we have inflation. We have CPI, which is a very volatile news event. So I need to be sure that I'm not swinging for the fences. This is the problem. So many traders will get into a trade and then they'll try to hold it for a 1 to 100 risk to reward trade. And then they just watch price come all the way back down to them. You have to understand what's going on. I know that in a few hours, we're going to have a CPI data release. I don't want to be in the market when that happens. So what I want to do is identify, okay, where's price going to go now? If there was no CPI, I would be expecting that price will trade into this high up here. That would be my expectation. But because there is CPI, well, I don't know if price is going to have enough time to get there. And given that it's CPI, we may expect that New York may be more consolidative. Why? Because people don't want to risk when CPI is coming out. They would rather wait for it and then act. So I'm taking all of this information in, and it's all part of my system. It's my process. I don't even have to think these things. My system does it for me. And so now I have to understand, where should I long? And so what I'm going to do is I'm going to long into obvious areas of liquidity. If you've heard me talk about liquidity before, you'll know that trend lines and Asia high are my two favorite areas of liquidity. So we have a trend line forming across here, we have Asia high forming across here, and we also have this fair value gap. I won't go too into detail today about fair value gaps because I don't want to give you too much to kind of overwhelm you. But we have a fair value gap here, and a fair value gap is important because it shows market imbalance. It shows inefficiency. And so these are areas where price is likely to retrace to at some point in time. So now I have my understanding of where price should target. I know what direction I want to trade in. I know where from I want to trade. I know when I want to trade, and now I know where to. And so now my trade idea is complete. And I haven't had to think about any of this because my system does it all for me. I just have to wait and look at price and go, yes, this has happened, cool. And then that's happened, great. And now this is happening, awesome. And so now I'm going to do this. And so now we've got this, I need to find an area to enter. And so where do I want to look at entering? I want to look at entering from a order block or a fair value gap. So 5 minute doesn't really have anything for me, although I could have probably gotten in on this order block in here. I didn't. The 3 minute time frame doesn't really have anything for me at this moment in time, but 1 minute time frame, right? This is also just before we get there because price comes back down. 1 minute time frame. What do we have? We have the range and the shift. We have the last sell before the buy. And so logically, I'm just going to indicate that I'm going to use this entire range, right? This is the range that I want to use. Why? Because we have the sell, the range, and the aggressive move out. I just want price to retrace back into the aggressive, right? As price trades out of this level, it trades back in, collects new liquidity, trades out, collects new liquidity, trades in, collects new liquidity. That is why the market forms like this. And so I just want to get back in after the confirmation. And so my longs go in here, my stops go below the lows in here, and now I'm looking for my targets. And so my target, or where I want to be looking for, is up in these highs in here. I think I had a little bit of a larger stop just to make sure that I got into the position. So the targets I want to be looking for are inside of these Asia session highs. And also we can look at the Asia session highs. We can also look at the fair value gap up in here. That is the overall trade idea. And so now in the 1 minute time frame, we just wait for price to react. We wait for price to give us what we need. And so if you play price, you'll see that immediately I get tagged in to the position. We have a little bit of a nice reaction. Price breaks the high, but we still have open areas of demand. Price comes back in and price goes, right? These are the natural ebbs and flows of price. Price then comes back in, expands back out. And then somewhere around here, my first level of take profit, you can see here my first take profit gets hit somewhere in this region. So just before price absolutely reversed, I got out at the top of this move. Then we have this aggressive pullback, right? But not before an aggressive reaccumulation. And then as we broke the high, a little bit more of my position comes off, and then we trade perfectly into this fair value gap. And then I kept on a very small amount of my position. As you can see here, right, a small amount of my position was kept open. Why? Because of the anticipation that it's possible that CPI may want to take us higher. So maybe we were able to reach for this high because this is the logical next step for structure. So maybe if we trade up into this level, it would add a nice higher average risk to reward. That was a bet that I was willing to take, and it was just a very small amount of my position. And then from there, that pretty much didn't play out. We had that reaction, and then this is where I got taken out of the rest of my position, right? As New York opened, I wanted to secure myself. I didn't want to get any slippage in CPI or anything like that. And then CPI comes out, and then price is finished. And so at this point for me, when this low gets broken down here, now we shift bearish. Here's the next day. Now what we have is I'm coming into this day and I'm expecting lower prices because we've shifted structure. No longer I'm expecting price to trade up here. Now I'm expecting price to trade down here, right, into this new low. And so what I'm telling my clients when I come into the market in the morning is if London session open can breach above these highs, right, because very important liquidity and fair value gap and order blocks sit above them. If we can get this move and then we can get this move, then I can look at selling. As you'll see, that didn't end up playing out for me, right? We didn't end up getting what we needed to see in order to be able to get involved in the shorts. So that's just the game. We're not able to catch every single move, even if we know what the direction is. But the most important takeaway here, knowing the direction is the most important thing, and everything else comes after that. If you have a consistent process that enables you to understand which direction the market will go 9 times out of 10, then you can add everything else on. That is the most important thing for your system. So again, if you want to work with me more intimately, more directly, and get access to all of my systems, processes, and plans, then below this video, I'll leave a link. You can book a call, speak to one of my team members, and see whether or not we can help you in your current situation.